Welcome to Investing 101, Understanding Mutual Funds. This presentation is designed to give you a clearer understanding of the features and benefits of investing in mutual funds. This knowledge can assist in exploring both the funds in your retirement plan and those you may invest in outside the plan. To increase your confidence in selecting funds within your employer-sponsored retirement plan, it helps to review the risks and rewards associated with owning those funds. A mutual fund is a pool of money collected by professionals to buy stocks, bonds, and other assets. Mutual fund managers are responsible for monitoring the investments within the fund to make sure they align with the fund's stated goals. The investments that make up mutual funds can include stocks, bonds, and money market instruments. Mutual fund investors own shares in the funds, which represent partial ownership of the assets. Investors take part in the gains and losses the fund's holdings produce based on how many shares are owned. Mutual funds investors may experience growth in their account balance in several ways. The net asset value of a fund is the current dollar value of one share, or the price the fund pays if an investor sells shares. Net asset value is calculated at the end of each business day and can move up or down. The figure is calculated by totaling the value of the fund's holdings and dividing by the number of outstanding shares, less management fees. In the course of fund management, profits earned by the sale of assets within a mutual fund are called capital gains. The investments owned by a fund may also pay dividends, which are the earnings on those assets. There are several advantages to investing in mutual funds. Experienced money managers decide when and what securities to buy, sell, or hold within the fund. When purchasing investments, they look at factors such as the financial health of a company's stock, industry trends, and the general state of the economy. Pooling your money with other investors allows you to acquire part ownership of stocks, bonds, and other investments with a small investment amount. Mutual funds may also offer you instant diversification. Your contributions are spread across many different investments. By combining your money with that of other investors, fund managers can purchase a wider variety of investments than the usual single investor. A greater variety of investments can help you achieve diversification, which in turn can help reduce risk. When you invest in a mutual fund through your retirement plan, any interest, dividends, and capital gains earned by the fund are reinvested in the fund, which equates to buying more shares. In addition, no taxes are due on these earnings while they are in the plan. Over the long term, this tax-deferred compounding can allow your account balance to grow much faster than in a taxable account. Now let's take a look at the types of mutual funds usually found in retirement plans. Money market or stable value funds are usually offered to participants as the lowest risk option. The goal of these funds is to pay interest and preserve the investor's balance. Both types of funds typically pay low rates of interest. Plan participants seeking low risk for their investments who will accept a lower rate of return than other funds offered in the plan may consider either of these choices. A bond is a form of loan or IOU. The issuer of the bond is the borrower and the holder of the bond is the lender. Bond funds offer the chance for a higher return than money market and stable value funds, but bonds and bond funds are also subject to interest rate risk. That means as interest rates rise, the value of existing bonds issued at lower interest rates go down in value. In times of interest rate downturn, new bonds issued at lower rates help increase the price and value of current bonds that offer higher interest rates. The most common bond funds made available in employer-sponsored plans are investment-grade bond funds, which buy high-rated government and corporate bonds, high-yield bond funds, which seek lower-quality bonds that offer higher yields than investment-grade bonds and are more susceptible to economic and credit risk, and international bond funds, which select bonds issued by entities outside the United States. Stock funds historically offer the highest opportunity for return as well as the most risk. Stock funds contain shares of publicly traded stocks, which are shares of ownership in a company that are traded on the stock exchange. Stock ownership entitles the shareholder to dividends and the right to vote on certain corporate matters. Contributors to stock funds become part owner of all the stocks in the fund. Owners of stock funds take part in the growth or loss of the value of the fund shares. Types of stock funds include domestic, which invest in U.S. companies, international, which invest in companies both inside and outside the U.S., emerging markets, which invest in companies located in less developed countries, and sector funds, which buy stocks in certain business categories. In addition to the geographical categories stated previously, stock funds are grouped by the size of companies they invest in. Market capitalization, or market cap, measures a company's size by multiplying the number of shares outstanding by the stock's price. Large cap is over 10 billion in market cap, mid cap between 2 billion and 10 billion, and small cap between 300 million and 2 billion. Another way to distinguish stock is by management style. Growth companies use their earnings to make themselves bigger through acquisitions or research and development. A value fund invests in stocks that the manager considers underpriced and expects to rebound in value. One way you can help reduce market risk is to diversify among different styles of stock funds. Although both growth and value funds may provide strong returns over the long term, their returns often differ significantly over shorter periods, because growth stocks tend to do better under a different set of economic circumstances than value stocks, and vice versa. Balanced fund and asset allocation funds form a bridge between stock funds and bond funds. These funds contain a combination of stocks, bonds, and sometimes money market type accounts, offering broad diversification within one fund. Asset allocation funds include target date funds, which are designed to align with a participant's retirement date, and risk-based funds, which are managed so that risk levels in the fund stay fairly constant with the fund's stated style, such as conservative or aggressive. Balanced funds aim for the middle-of-the-road approach in the mix of stocks to bonds and can be described as having a moderate investment style. Risk is defined as the uncertainty that an investment will earn its expected return. As mentioned, businesses, government issuers, and investors bear several types of investment risk. Market risk is the risk an investment will drop in value due to factors that affect the financial markets overall, like a natural disaster or a recession. Business risk pertains to issues that impact a particular business, such as poor management. Credit risk applies to bonds and bond funds and is based on the issuer's overall ability to repay investors. And finally, inflation risk is the risk that investments will lose value because their returns will not keep up with the cost of living. If inflation increases and a participant keeps all their assets in very low-risk investments, such as money markets or stable value funds, the net result could equal a near-zero rate of return. This chart illustrates the trade-off between risk and return. Risk is the uncertainty of how much investments will move up or down in value. Return is the opportunity for gain in the value of investments. Investments that provide predictability and security receive a low rate of return. The chance for higher growth in the high value of an investment also increases the risk involved. A higher rate of return requires an investor to undertake greater risk. Personal risk tolerance is an important component of determining asset allocation. Factors like current age and life expectancy influence each participant's acceptance of the various risks associated with investing in a retirement plan. Younger participants often feel comfortable choosing funds with greater risk, trading stability for the opportunity of a higher return. Participants with 10 years or less until retirement may find that they have not saved enough money and want to take on more risk than indicated by their risk tolerance. Your Human Resources Department can provide you with a risk tolerance quiz. Taking this quiz helps you determine your investment style and which investments in the plan might best suit your profile. A more in-depth quiz can be found on the Alaris participant website under Resources. You can find more information on the funds available in your retirement plan through the Alaris participant website. Fees and expenses in mutual funds refer to the costs of operating a fund, such as management fees, and expenses such as trading, legal, and auditor fees. Reviewing fees and expenses lets an investor understand how much it costs to own the fund, as the fees and expenses are subtracted from the investor's rate of return. Congratulations on successfully navigating Investing 101, Understanding Mutual Funds. Participation in your plan represents an important commitment to building a comfortable retirement, and taking the time to expand your investment knowledge is time well spent. If you have any additional questions, please contact your human resources representative or call Alaris directly at 800-433-1685.